Guys, AI is absolutely changing the world today and for the future. We're going to look at 5 companies right now that involve chip making as well as services that will be benefiting from AI. But remember, AI is changing the world just like cars did, just like airplanes did, just like the internet did, just like computers did, just like electric vehicles did, just like every other thing we've seen in the past that has ended up being a little bubblicious. Now, do I think that AI is leading to big jumps in stock prices that might not be justifiable? Absolutely. But we're going to get into that on every individual company, and we're going to run it through our stock analyzer tool to see. So let's go to the first one. The most obvious one is Nvidia. Nvidia is hype city right now. It's up 244% in the last 1 year alone. In the last 5 years, 1,950%. Guys, year to date, it is March 20th. 85% year to date. In literally under 3 months, it's up 85%. 6 months, 111%. Everything here screams hype to me. I was with friends recently and somebody was bragging about Nvidia and they literally said, I don't even know what they do. And I just went, oh my. I said, hey, shouldn't you know what the company does before you invest in it? Either way, that seems a little hype-ish and bubble-ish, but let's get into it. Nvidia is a phenomenal company. It has crossed $2 trillion in market cap, okay? And then look at this enterprise value, the exact same. So this company has a great balance sheet. This difference right here will show you the amount of debt on the company, essentially. There's practically zero, okay? Look at this adorable little dividend yield, 0.02%, $395 million. Guys, 5-year average free cash flow, $9.6 billion. Last year's free cash flow, $27 billion. That is astronomical growth. Look at this return on invested capital. Last 5 years, 22%. Now it's 45%. This is the return they get on the money that's invested in their business. Guys, I want to show you guys what analysts are saying about this company. Now remember, analysts have to make sure they stay with the hype. Everybody has to remember that. $12.55 a share to $34.86 a share in 2029, tripling. Now, guys, if you recall, I've done many videos about this. Intel, Cisco, a lot of companies, at one point Micron, back in 2000, were changing the world. And a lot of those companies haven't seen the same price that they had back in 2000, even though revenue and profit are several times higher. I don't know where Nvidia is going in the short run. But remember, in the short run, stocks are a voting machine. In the long run, they're a weighing machine. That means that in the short run, what's popular is going to go up, what's not popular is going to go down. But in the long run, this is what's going to drive stock values, the earnings per share. Now, the question is this justifiable? Well, guys, at $34.86 in 2029, let's say the analysts are right about this. Spoiler alert, they tend to be wrong in the long run. But let's say they're right about this. The stock is currently at $891 a share. $891 divided by 35, call it 27 times. Is that right? I have no idea. Maybe it's 26 times. Whatever it is, 26 times 2029's profit. Oh boy. I don't know. Seems a little rich. But let's go to our stock analyzer tool and see what it's worth. So I did it back on February 20th. And here are the assumptions I made for the next 10 years. 10% growth, 20% growth, and 30% growth. Guys, these two numbers are huge. Now, is it possible they do 20% a year? Absolutely. But a $2 trillion company, the third largest market cap in the world, essentially, growing 20% a year revenue? Maybe. Remember, guys, they've done $60 billion last year in revenue. Intel did $58 billion. Now, I know Nvidia is on a much bigger growth trajectory than Intel. I get that. But it's just keep that in perspective. Profit margin, I did 20, 30, 40. This is probably low because if you look at their profit margins here, the last 5 years they've done about 35%. I don't think this is sustainable. The 45 to 48%, you got to remember, they've had practically no competition. But now AMD is making chips. Intel will make chips. More and more companies will make AI chips. So just keep that in mind. PE, they're currently at 74 and a price of free cash flow of 81. I did 20, 25, and 30, which is still aggressive. And I did the 9% return here. Hit the analyze button. Remember, 9% has no margin of safety. As Seth Klarman always says, we need margin of safety for 3 reasons. 1, valuation is an imprecise art. 2, We don't know the future. It's unpredictable. And 3, we're humans. We make errors. That's why you need a margin of safety. That's why you should put a higher number than 9%. Because if you just want 9%, just buy an ETF. But either way, hit the analyze button. Guys, I have a low price of 150, high price of 2,000, and middle price of 590. And that's assuming these 20 and 30% growth rates with really, really high margin. Is it possible? Sure. But are you banking on what's possible or what's probable? That's the question. All right, stock number 2, AMD. These guys are crushing it as well. All part of the whole chip manufacturing. I think AMD is at all-time highs or pretty close to it. All-time high was reached 227.30 back on March 8th, just 2 weeks ago, not even 2 weeks ago, 227.30. Guys, look at this. Let's go 10 years in this company, 4,300% return. This company was $1 per share, $2 per share back in 2015. Back when the Cavs won the title, back in June of 16, they were at $5 a share. $5 a share. If on June 19th, when the Cavs won the title, I'd bought AMD stock, it'd been a glorious day for me for 2 reasons then. Because I would have bought $5 stock that's now $227 $180, sorry. Oh, wow, look at that. That's a big drop from its, I didn't even realize that. You see this? It's currently at 180. Just 12 days ago, it was 227. A lot of volatility. Okay, they did revenue of $22.68 billion last year. Great balance sheet again, $290 billion market cap, $300 billion enterprise value. That difference is very little in terms of, but look at this. This is interesting. 5-year free cash flow, 1.7 billion average. Last year was only 1.12. Oh boy, seems like a lot of hype here. Let's see what the analysts are saying about this. Big growth in, look at this. This year, 386 a share, 2027, 850. A lot of growth. But again, if you pay too much for a great thing, you'll still get a bad investment. Don't forget that, guys. True investing is about understanding that you can pay too much for a great thing. Because if you pay too much, you're not going to get a good return on your money. All right? So let's go pull up the stock analyzer tool. I did this on February 27th. Okay. So I did 8, 12, and 16% revenue growth because they're actually pretty low on revenues in the $20 billion range. 8, 15, and 22% profit margin, which is significantly higher than the last 10-year average. Free cash flow, I did the exact same thing. PE, I did 18, 21, and 24. And again, the 9% return, no margin of safety. Hit the analyze button. All right, I have a low price of 28, high price of 175, middle price of 180. Sorry, of 80, not 180, 80. So we got to wait a little bit for this company. So if I think it's worth 80 for my margin of safety, and I'm not like dying to buy it, but I have my watch list at 50. I think I'm going to change that now to 60. Because remember, guys, I'm modifying it as the fundamentals get better. That's the important part. As fundamentals get better, you have to reevaluate the companies and adjust your values, just like the stock market. All right. So, guys, the big part of this is you're watching this video for one reason. That's obviously to make more money. And investing with confidence takes the right process that works for you and the ability to handle your emotion. Everyone in history, including Warren Buffett, has made terrible financial decisions because of emotion at some point in their life. Nobody's immune to that. But the greats in investing are the ones who handle their emotions very well. It's no secret. Go look at Munger. Go look at Buffett. Look at these guys who sit there and say, we love it when stocks go down. And we can all relate to seeing a stock fly high like Nvidia or AMD or drop fast and have to worry we're either missing out with FOMO on the gains or is our stock going to zero? This is a fear that everybody has had. We've all been there. And the right emotions coupled with the right process can greatly decrease your fears. You can focus on the truth behind the numbers like we're doing here to make better and more profitable decisions. And the best thing that happened to me since investing millions of dollars to create this community in software is realizing that I am not the best investor in this community at all. I now have better investors to bounce my ideas off of, and we have each other to keep our emotions in check when doubt starts to creep in. Or another alternative is I hear a different viewpoint on my investment ideas to make sure I'm thinking of more angles. Just yesterday, I had a stock and I went in the community and said, guys, I'm looking at the stock. Please tell me what you think. So I use this software and I engage in the community every single day to help make these better decisions and to work on my process and my emotion. And every successful person you know has been one great connection away from changing their life. So if you want to join the community, it's 7 days of access for $7. Click the link below to test it out and see that it will absolutely change the way in which you invest and make money. So I will see you in the community at that link below. Now, the next 3 companies are all software businesses. They don't make the chips, but they all use AI and they will continue to use AI to make their software better. First one, Adobe. Guys, I effing love Adobe. Talk about a great software subscription business. These guys have the best photo editing software out there. And instead of just selling you a CD now and saying, hey, pay $300 for this, what they do is they say, hey, pay us $29 a month and you get all the updates, you get everything here, which I love. Now, look at Adobe's stock price here. It hit an all-time high in 2021 of $700 and a one-year low of $331. But let's see what the actual low was here. $274 back in September of 22. It went from $700 in November of 21 to $274 in September of 22. Just remember that when you think that stocks can't fall fast, okay? Great stuff here. Again, great balance sheet, which I love about tech companies these days. 100 years ago, if you wanted to grow, you had to go build a factory and take on debt and all these things. Now, with services and tech companies, they're being smarter about their balance sheets. And the smarter they are about balance sheets, the longer the companies will last. And that's what I love about these. No dividend, which I love. Great gross margin here, guys. Look at this, 88%. Every extra dollar they sell, 88 cents goes to the bottom line to pay taxes and interest and overhead and everything like that. That's incredible. That's incredible. I am surprised by this. Profit margin last year was 28%. The 5-year average is 30%. That's kind of surprising. That is kind of surprising. But here's what I love also. Free cash flow last year, $7 billion, 5-year average of 6.1. The corresponding net income is much lower. So they're generating more free cash flow than net income, which we love to see because it's easier to fudge this number, net income number, than it is to fudge the free cash flow number. So I like seeing that a lot. All right, let's go see what analysts are saying about Adobe. Ooh, okay. Double-digit growth on EPS for the next 4 or 5 years. Revenue, double-digit growth on revenue. So this is a company that's going to continue growing with really high gross margin. They can throw a lot more money to that bottom line. That's really, really important here. All right, let's pull up the stock analyzer tool. Let's go find this company that I adore so much and see what price I want to pay for it. So my assumptions, 6, 10, and 14% revenue growth, 26, 29, and 32 on the profit margin. Guys, this might be low because with such a high gross margin, as they grow their revenue, they don't have to increase their overhead as much. This actually might be a very low number. And look at this free cash flow. I'm going to focus on the free cash flow number. And I did 38, 40, and 42. I did a PE of 18, 21, and 24. Also could be low. That's why having the software is great. You can make your adjustments here. And I actually did put in, well, let's put our 9% number in. No margin of safety. Hit the analyze button. So guys, I have a low price of $344 based on cash flow, a high price of $870, middle price of $548. The question is the current price today enough margin of safety to buy it? That's the question you have to ask. I have it on my watch list at 400, and I'm comfortable with that right now. I'm very comfortable with that. Stock number 4, the second best subscription-based business in our opinion, Microsoft. You guys have all heard my story about Microsoft hitting all-time highs now. I owned Microsoft at 17 to 22 bucks a share back in 2012, and I sold it at 60. Suck it. Now it's at 420. That's a good one. 7x from there. I was already up 3 times. It had been a 20 bagger for me, but who cares about making money, right? Great balance sheet. They paid dividend. Look at this, guys. Their dividend is 0.66%, which is peanuts. But look at how much they paid out. $21 billion. I just read yesterday, like Apple and Microsoft have like a 0.5% dividend yield, and yet they pay out, $100 billion, not $100 billion, it's like $50 billion a year in dividends. That's incredible. Why? Because look at this market cap, $3 trillion, the most valuable company in the S&P right now. Enterprise value is a little bit above that, but they generate so much cash flow here. Ooh, look at this. Surprised by this. Free cash flow 67 billion and income of 82.5. That's significantly lower. Interesting. 5-year average of 55 billion, 5-year average net income 63 billion. Interesting. Oh, by the way, all these 8 pillars basically look the same. 6 checks. And the only question is their valuation metrics. They're X's, but again, they could be fine if they're going to grow 30% a year or some crazy number like that. You can overpay like crazy. Analyst estimates, $11.50 a share this year, driving up to almost $20 a share in the next 4 years. Basically double-digit growth and revenue growth, double-digit again. Jesus Christ. That's a lot. Well, let's pull it up in our stock analyzer. Let's see how it looks here. All right, guys. So I put 6, 9, and 12% revenue growth. I want to be a little more cautious. This is only going out, analysts are only going out 4 years. I'm going out 10. Profit margin, 32, 34, 36. Free cash flow, 28, 31, and 34. It might be justifiable to go higher. Same reason as Adobe. As they add more subscribers, paying a monthly fee at a higher margin could justify it. PE, I'm going to change this PE. Watch what I'm going to do here with PE. Guys, I want to pay for the nose from Microsoft. I love that company. And I think this is a justifiable PE. 9% desired. I did 20, 23, and 26 on the PE and price to free cash flow. Hit the analyze button. I got a low price of 200 to 220, high price of 460 to 490, middle price of 300 to 330, and I have it on my watch list at 250. I think I'm going to increase this just slightly to 275. It doesn't mean I'm buying it at 275. It means I'll reevaluate it, and I might sell puts on it to get it at lower prices. I was just teaching my stepson yesterday about that at home. So final stock, Googly Moogly. Now this company, guys, fundamentals have gotten better. All-time high, 155.20 back in January. But if you look right here, it was pretty close to this back in late 2021 when the roaring bull market was happening. So it's basically even over the last 3 years, 2.5 years. It's at 148 a share right now. I think Mo owns this company now. He bought it like 140, I think. I don't remember what it was, but you can see that back in our old videos. But again, great balance sheet company. Market cap of 1.85 trillion, enterprise value of 1.86 trillion, free cash flow of 70 billion, net income of 74 billion. I mean, it's incredible. So here's the deal, guys. Free cash flow is 70 billion, market cap is 1.85. Remember Microsoft. Let's go back to look at Microsoft. Free cash flow of 67 billion and a market cap of 3 trillion. That's a lot. I mean, so it's the same free cash flow, but look at the market cap difference. Just remember that, guys, when you're looking at companies. You got to ask yourself, is Microsoft that much better of a business than Google to have the exact same free cash flow last year, but 40 or 50%, no, maybe more than that, 70, 80% higher market cap? Think about that for a second. Same free cash flow. Microsoft is a much higher, and I think Microsoft is an incredible business. Absolutely incredible. They have a higher gross margin and a higher bottom line margin than Google. But it's Google. They own the top 2 search engines in the world, Google.com and the very thing you're watching right now, YouTube.com. All right? So let's go take a look at the 8 pillars, just like Microsoft. 6 checks, 2 X's. I really, not a huge fan of buying back shares. I get it. They think their stock is undervalued. Let's see if we think the same thing. But analyst estimates, growing earnings per share by double digits here. I probably made a mistake not buying Google with Mo. In fact, I had Google at one point about 1.5 years ago. I wanted to buy it sub 85 a share. I think I got to like 86. I never pulled the trigger. Boom. It's the way it works. That's the problem. Was I smart? I don't know. It could be a dumb move. I have no idea because I think the stock is worth well more than that now. So let's go look at the stock analyzer tool. And remember, guys, click the link below for our community. It's $7 for 7 days. All right. 10-year of analysis, 5, 8, and 11% revenue growth, 22, 24, and 26 on profit margin and free cash flow margin. Even though free cash flow in the last 10 years has been pretty similar, the last 5 years, free cash flow has been a little bit lower. So make sure you watch for that and why that's the case. PE, I think I'm going to do a higher PE, guys. I don't think Google's going away. I don't think YouTube's going away. And I'm going to do 9% across the board. I did 20, 23, and 26 PE and price of free cash flow, and desired return of 9%, no margin of safety. And look, 114 on the low side, 260 on the high side, 173 in the middle. If you buy at today's price and my numbers are correct, you basically make an 11% return. Is that enough for you? So guys, if you want to see all 30 companies that I want to own in the future, watch our next video and don't forget to sign up for the community.